2, 1, and we are live. Welcome everybody, it's Masterclass time. Treasury Masterminds webinar Masterclass with TreasurySpring today. One-day liquidity, solving the Treasury trade-off. Today, it's all about cash you might need tomorrow. Not in a week, not in a month, it's really about tomorrow. And what options actually exist when you refuse to gamble with it. We're going to talk about repos. We're going to talk about central clearing. Sounds all difficult, but we're going to start easy. We're going to start build it up. Definitions, deep dives, use cases from the Treasury side, from the practitioner sides, and from the product side. Let me introduce you our speakers. We have Saneh Mamouri, Treasury Masterminds, board member and treasurer. Then we have Katja Renner from Eurex, Central Clearing. We have Jasper Steger from NN, and we have Glenn Stone, the head of trading and execution at TreasurySpring. A lot of experience in this room. Please ask questions. Use the chat on the right-hand side. Ask them in between. There's room at the end for questions, but if you have a question, just ask them in between. We will see them. I will moderate them, and don't be shy. Ask the audience. This is your opportunity to ask your questions to these speakers. But without further ado, let's dive into it. Let's start a bit with the definitions. Katja, can I start with you?
Sure.
Can you explain to me how central clearing would work in relation to a repo investments? It's for me, it sounds a bit like this is what banks do. This is not something treasurers would do.
Sure. Well, let me start by demystifying the two words that often sound intimidating: repo and central clearing. So most treasurers probably think a repo of something banks do on a huge trading floor, flashing screens, complex activity far away from day-to-day treasury activity. But in practice, a repo is a simple secured cash transaction. So at the core, it works like you place your cash for a defined period. In return, you receive high quality collateral, typically government bonds at maturity. The cash comes back plus interest, and the collateral goes back to the counterparty. From a treasury perspective, it's not different from a secured deposit. But now let's talk about central clearing, because that's the real game changer here. In a traditional bilateral repo, you face a single counterparty directly. You carry the counterparty's credit risk, you negotiate legal agreements one by one, which can take a very long time, and you rely on the counterparty to manage collateral correctly. That's fine, but it doesn't easily scale and it concentrates risk. So central clearing introduces a neutral third party, which we refer to as the central counterparty, or in short, the CCP. Think of the CCP as a financial clearinghouse that steps in the middle of every trade. So the CCP becomes the seller to every buyer and the buyer to every seller. So you no longer face multiple counterparts directly. You face one highly regulated, systemically important entity instead. The CCP standardizes processes, mutualizes risk, removes reliance on bilateral trust. So what exactly, or actually, does the CCP do? First, it manages counterparty risk for you. So that means if one counterparty fails, the CCP ensures the transaction still completes. It's not based on goodwill. It's backed by strict risk management rules, margining, and default management process. Secondly, it simplifies operations. Instead of multiple legal agreements and settlements with many counterparts, you have one legal framework, standardized collateral rules, and automated settlement. And last but not least, the CCP gives you access and choice without adding complexity. So with the CCP, you can place cash with many banks through a single setup, while the CCP ensures the security of the transaction. And quite likely you get very competitive rates without multiplying risk. So when you take a step back and you look at it, cleared repo is not about becoming a trading desk. It's about using market infrastructure to invest cash securely, efficiently, and well, at scale.
Yeah, no, yeah, makes sense. Jasper, logical bridge to move to you. You're an institutional investor. You're using these products probably on a weekly, monthly, maybe even daily basis. For you, this is normal business. But why has this market been closed off for treasuries, for corporate treasuries, for years?
Yes, hi all. Yes, Jasper Steger and men. We work for some Dutch pension funds. So actually, I'm a treasury at an asset manager, and we do use Eurex repo daily basis for our larger accounts. And we actually start to use it since a couple of months, also for our smaller accounts. And that's the part you're asking at. It's used to be difficult to enter this market as a smaller account, or not being an investment manager and being a corporate treasurer, as the burden, the threshold economically, and also the solutions for a default fund contribution and other obligations which comes along with it was like a burden, a threshold. It's been taken away step by step. And so for our larger accounts, we are on for like 5 years, I guess, 6 years, maybe 2021. And now we are here for smaller accounts as well, with the threshold of the economics being lowered.
Yeah, makes sense. Sanay, let me hear your opinion as a treasurer, a personal opinion of you as a treasury professional. How do you think of overnight liquidity anyway? Overnight investments, because often investments is about excess cash, a week, a month, maybe a bit longer term. But how about one day? Is it worth the effort? How do I plan it?
Honestly, my position and my view on the topic has changed over the years. To be quite honest, overnight liquidity were not something I actively considered or relied on in the past. At the time, they felt like a relatively opaque area of cash management. The mechanics were not always straightforward, and the underlying structure was not sufficiently transparent. And from a treasury standpoint, that automatically translated into perceived risk. So in a company or in a regulated treasury environment, anything that cannot be clearly explained, especially to our management, that cannot stress test or govern, and tend to be approached like with caution, if not avoided, sorry. Liquidity. So liquidity is fundamentally about certainty of access, certainty of valuation. In corporate companies, sometimes we don't have even an idea about when we will have an acquisition. We have some confidential business that can come for treasurer at last minute, and at last minute they should be able to take the decision to take the cash out. So if those elements are not fully understood, it becomes difficult to justify my investment overnight, regardless of the yield. So what has changed over time? It's not like the shift of the risk appetite, but rather it's a gradual improvement in transparency, communication, product structuring, and disclosure. As this solution matured, with the time, it clearly ruled around liquidity access, counterparty exposure, operational processes, and it became possible for us to assess them more objectively, within our treasury framework. That evolution allowed me to move from, this position where of a total avoidance into a more informed evaluation of, the various products we want to invest on.
Yes, no, makes a lot of sense. It opened a lot of doors. Technology helped. Glenn, let me go over to you because you're trying to solve this problem which Sinead described. Access to more markets, more security, counterparty risk, but also flexibility. If I need my money back tomorrow, I need my money back tomorrow. That's key priority, what I hear from Sinead. So you're trying to solve this with your product One Plus. So how would a transaction via your platform work? Walk me through it.
Hi, morning everyone. So thanks for the question. Effectively, our One Plus product is really a series of overnight repos. So we would transact them T0 and then they effectively contractually unwind the next day. And given that we've got the QCCP, so qualifying CCP in the middle, that's a pretty much very high level of certainty that the money is coming back on the next day. If I just I'll try to briefly answer the question simplistically. There's two ways that I'd approach it. First is there's a mechanical process to follow. We are using a directed RFQ model where we come into the market in the morning. We use Eurex's proprietary trading system. We would direct a request for, to borrow collateral, lend cash to market participants. As we do this T0 with cash on account, there's an automatic novation to the CCP, so there is no bilateral credit risk in there. You can invest in longer tenors, obviously, but the structure of our One Plus product is always that the trade unwinds the next day on a contractual basis, so cash and securities settle the next day. If I then just quickly break it down another way to look at this is we often talk about security, liquidity, and yield. The best way we can look at this transaction like construct is from a security perspective. We're looking to place the loan of cash versus very high grade collateral. In general, we use Eurex's ECB Classic basket. This basket is essentially what sort of wholesale participants would call level 1 HQLA, high quality liquid assets, which in turn really means highest grade collateral possible that is effectively under stress, then cash convertible, could be used to go to the central bank to raise cash with. So that's just security wrapper in there. Once we've sort of selected the security, the next thing we're looking at is liquidity. So T0 repo on this level asset pool is probably one of the deepest markets out there. It does clear very early in the morning, but this is really where wholesale participants come to fund their books. They're long government debt, they're long this type of asset. It's a very, very effective place to come and raise cash, to do this and could clear this out in the market. And there are numerous regulatory incentives that I'll come to later on that wholesale participants will choose to use this market. And the final point to really look at this is yield. I mean, obviously, yield is part factor of, this is partly driven by where this market clears at its deepest point, but we do see yields improving constantly relative to ECB deposit rate here. These incentives, again, by banks and, mainly banks paying up to finance themselves here, are driven by capital efficiencies and in particular balance sheet. But being able to tap into this is very time sensitive and non-discriminating fashion is key to unlocking the levels. So the pipework access, and the approval into this is key here. So by enabling to use these pipeworks we put in place, treasurers can come to us, effectively access this market by using us as a bridge into what is one of these deepest pools, paying very, very good levels on an overnight basis.
Yeah. So you're saying it's not necessarily a trade-off between risk and return. Lower risk doesn't mean lower returns. It's about the size of the market that determines the returns. In
a way, I mean, I was going to make a statement. It's a bit like, you you want, three things, and sometimes you are trading off. Now, the one time you don't trade off is when you've got the cost to invest to build infrastructure. So, the cost of repo traditionally is very, very high. I think we've seen a lot of commoditization over the years, particularly with advancements, from tri-party agents, Eurex, Deutsche Börse all working together, have commoditized a lot of the difficulty. But your traditional underlying building blocks of a repo business are hugely expensive, where you're from a system, custody, even management of peripheral process like corporate actions, etc., is hugely complex and expensive. So this product aims to leverage, what is best of breed built from Deutsche Börse, Clearstream, but also, we can then remove some of the legacy considerations that people would have had to build into repo businesses.
Yeah. That's a very good point. If I may add there, it's also as Eurex steps in as buyer to the seller to the buyer, as a CCP. It means also for the bank participants there that it's all netted down in terms of exposure, and they are in a position to provide more liquidity as they manage their balance sheet efficiency the way they're positioned. And also on balance sheet dates, there's abundance of liquidity available for your positions to transact.
Yeah, so it's still a good time to invest in it at year end, at quarter ends.
In my humble experience, compared to single bank bilateral repo or depot, yes, it's
interesting.
Yeah, the level, I back that point up. The level drift that we see as these sort of observation points isn't anywhere near what you would see in a bilateral basis. And you remember, if you're building a repo business, you don't want to just have one bank in your panel. You want to have multiple banks. So the good thing about Eurex is it opens you up to a whole universe of banks that can be positioned slightly differently, and you still have an active and deep market.
Okay, so now this 1 in a million happens. A bank fails or a counterparty fails. That counterparty is in my investment pool. Katja, what happens?
I know it's not a very popular topic, but it's a very fair question, because this is exactly where people worry things could get messy. But let me explain you what's actually happening in a cleared repo if a counterparty fails. First, you need to understand you are not facing the bank directly. You're facing the central counterparty. The CCP is the legal counterparty to the transaction. So when kind of the other party fails, so there's no renegotiation, no emergency calls, no decisions to be made by you, by the corporate treasurer. There are three things what happen basically automatically. So as I said, the CCP is the legal counterpart to your transaction. It's legally obliged to complete the trade, which means the trade continues and the trade matures on the maturity date as initially agreed. The counterparty's failure is absorbed by the clearing infrastructure, so it's not passed on to you. Secondly, as the collateral is already secured, the collateral backing your cash was delivered upfront and is already under the CCP controls, which means there is no chasing of assets, no legal uncertainty, no reliance on a failed institution. If needed, the CCP steps in and can liquidate the collateral to make sure the cash is returned. And then last but not least, losses are absorbed well before they reach kind of the corporate treasurer. And the reason for that is the CCP has multiple layers of protections. It's margin, it's default fund contribution, and then also the CCP's own capital, which we refer to the skin in the game. That's designed specifically to handle counterparty defaults, even in a stressed market. But for you as a cash investor, you sit far away from the loss edge. You could argue in a cleared repo, counterparty failure is a managed process. It's not a crisis. You stay invested, secured, operationally unaffected, while the CCP does all the heavy lifting in the background. The value of central clearing, it determines a default from a headline event into a non-event for a corporate treasurer.
Yeah, makes a lot of sense. Now, hearing all this, Sanne, does this fit in our treasury policies?
Yes, to complete what Katja just mentioned, it fits when it is clearly embedded within the Treasury policy framework. That means defining it explicitly as a cash investment instrument, defining the clear limits of the product, the governance, the risk criteria, all the elements that Katja mentioned needs to be defined, in the policy. But it's not only just to on our side as cash manager, just to remind that it's not about replacing the core liquidity tools. It's about broadening the toolkit in a controlled, in a policy-driven way, ensuring it still aligns with our, investment strategy, capital preservation, and operational needs.
Yeah, makes sense. I've seen treasury policies, investment policies, which are very short. It's based on counterparty risk. It's based on maximum levels of investments, different types. I think hearing you and Katja, this could always fit.
And it depends as well, from company to another. We define our threshold. So from that threshold, whatever comes, it's the excess cash, the level, then you decide. So if it is an important, then you diversify your portfolio, and then you have more margin to enrich your policy. If we are talking about limited cash, then even the policy or the products are limited. So
yeah. Okay, Glenn, you can probably talk us through some client use cases. What do clients do? What type of strategies do they use? Is this really this daily rollover? Do they have baskets? Talk us through some. Glenn, you're on mute.
Sorry, it does. A lot of this comes back to the security, liquidity, and yield triangle. Again, it's a bit, I liken this a little bit to my old past of riding race bikes and competing, that everyone wants lightweight, aero, and stiff bikes. But normally you trade one of those off, or you spend 15,000 euros on a race bike. So we're all kind of in that framework here. But I think most of our clients really use it because it gives the best balance of return across security, liquidity, yield. The security aspect of it is secured against QCCP. So qualifying CCP is where the regulator deems it to be almost the highest grade of potential credit in the system. So from a wholesale participant, they're given an incentivized RWA capital treatment for bringing business there. From a liquidity perspective, which is probably the most important thing here, is firstly, it's an exceptionally deep pool of money where you can place into. So there's no real barrier for corporates to come to market. You can't get sort of capped on size. Generally, what we've seen so far, I think in other products, there could be a potential limit to how much you could put into a short-dated product. Here it is so deep, we haven't seen that cap yet. And the other thing as well, where we are structuring a series of overnight repos, the unconditional return of capital every day is a real sort of attraction for a lot of our clients. It's not that they, it's the comfort that they can get their money back within a day should they choose not to roll is really important for people. It's not, they don't tend to use it as like a bank account, but they do tend to use it as cash they may need, for something that comes up. And again, people do like the yield. It does pay a reasonable yield compared to the risk class. It's not like it compares very closely to, say, government money market fund from a yield perspective. And people tend to like that sort of negative correlation away from the financial sector. There are other instruments out there which, having a balanced treasury toolkit where you might have some instruments that pay higher returns, like prime money market funds, are great, but there's also the ability by, some of our treasurers like to use this alongside those prime funds because it gives you a slightly different risk class, which in general isn't correlated as such to the sort of financial sector and how those prime funds are constructed. And again, the one thing that we do always come back to is, very much that our clients have fed back to us is just purely unconditional unwind. That if they choose to get to the point where they don't want to roll, the money can come back, and it could come back as early as same day. But once they're locked into the roll, they trade the overnight, they guarantee to get the money back the next day. So that's probably the biggest single draw.
Yeah, makes sense. Jasper, hearing this from an asset manager perspective, I get it. It's almost a no-brainer to use these tools. It's all about liquidity, low counterparty risk, and the yield is still pretty okay. Is there still a risk which we haven't talked about?
There's always a risk, right? But it's as said, it's a tool. It's about the combination of possibilities. So we also use money market funds, and we also do bilateral and direct outright on short European government bonds. It's the combination which makes it strong. And a big advantage compared to the other possibilities is the possibility to increase and decrease significant amounts on a daily basis, which is important to us. The risks are to far extent mitigated, but still there is, as Katja emphasized or elaborated on the default process. It's still depending on the full members, of course, and the strengths of Eurex and Deutsche Börse as being the parent, and they provide the letter of comfort there. But still, it's depending on default fund contribution and an additional round when a large participants might get into a default, but it is highly mitigated.
Yes, well, makes sense. So the biggest risk you're almost saying is I end up with collateral I didn't sign up for.
No, I don't think that is a risk in the end, as Katja will take care of the liquidation of the collateral if needed. But yeah, maybe Katja is in a better position to.
Yeah, but also the collateral, what the CCP allows and accepts, we are talking high quality investment grade bonds, and we also only accept bonds which are liquid in the secondary market. So if there is a fire sale, that we still can achieve a very fair price in the market and do not need to sell it with a massive discount because they are illiquid assets. So and obviously this is for the ones who are cash taking and collateral providing. They would like to see that we accept lower quality assets, but this is not happening because we need to ensure that all of our participants are protected.
Yeah, and to add on top of that, we as pension funds, we are highly regulated as well, and we're not allowed to take on liabilities for other market participants. We do not have a banking license, so we work with a full member who does the default fund contribution to us, and also in case of a fire sale, the full member might need to step in to take some of the collateral, but me as just a basic member, being a basic member for the underlying accounts, we will never be forced to take a part of the fire, of the liquidation of a defaulted entity and the collateral.
Yes, makes sense. Sane, hearing this, what should we do now as a treasurer? Should we look at the risk? Should we look at the yield? Is it all eggs in one ultra safe basket and it's done? We don't have to worry about it anymore. We can get our liquidity back tomorrow. It's all centrally cleared. Katja confirmed us. You will always get your money back almost. So it's an easy job.
Yes. So risk versus the reward is, not everything is part of the equation, but it's not the whole story, in our treasury. I see in one of the comments, one of our biggest challenges at the time is everything is urgent. Yes, because, that add to, my criteria is not only the reward, is only is the liquidity as well, the access to cash, the predictability, and, the simplicity of use. So they are just as important. Excess cash isn't, a free capital. It can be needed very quickly. So I expect that I have access to it at the moment, I want or I need it. The real question is not only what return I will get, but how much, uncertainty I'm introducing in my liquidity portfolio. So this is from one part. And you mentioned as well, all eggs in one ultra safe basket. Yeah, so absolutely. I know. Yeah, we have some like what Katja emphasized. I can see it's very safe, very secure product. Just from our side as corporate treasurer, we tend to want to go about more diversified profile, not concentrated, not concentrated in one basket. Even, in so-called ultra safe instruments, practically it means to us that for liquidity, keeping immediate operational cash access to ultra liquid cash, while allocating a portion of surplus to across different, low risk instruments. It's about balance, resilience, and avoiding dependency on one single, solution.
I think so. Can I just jump in on that? I think it's an important point. I think raising diversification is obviously is massively important as a risk mitigant for people. But I think what often people miss is undue correlation. You can end up, you might have what looks like a diversified pool of opportunities, but they can all be highly correlated to the same thing. And, if you end up with, 10 banks in your investment portfolio, guess what? They all tend to be slightly correlated to the same risk buckets, So sometimes having something that is non-correlated in your treasury policies is a good thing. So it's about bank, government, maybe something like Eurex, and which Eurex is quite a good proxy for that government risk. It's about balancing it out. And then there is always this trade-off between your sort of pure financial products, generally probably pay quite nice yields, versus something that is safer, probably slightly lower yielding. But again, it is about building up the diversification, but also by managing your correlated risks within that same framework as well.
Yeah, no, makes sense. So what would happen now? I'm triggered a bit by Jasper's comment. It's traditionally only accessible for the big players. Now via TreasurySpring and indirectly via Eurex, this becomes available for smaller players as well. What does this mean for the market, Katja? Can the market handle this? Will the dynamics change?
It's true. Repo historically was seen like a wholesale market, bank to bank, designed for large financial institutions with scale, balance sheet, and infrastructure. But over the last couple of years, we have seen a step-by-step democratization. It was not a sudden jump. So platforms like OnePlus, TreasurySpring have helped broaden the awareness of offering indirect, simplified access. And that has been helpful, but also we simplified our access models. We have had a custodian kind of like taking on some of the burden. But I would say from a Eurex perspective, the long-term evolution is about cleared repo becoming usable as market infrastructure, not making smaller treasuries into trading desks, certainly not. But with cleared repo, a treasury faces kind of one counterpart, the CCP, and has the benefit of the standardized collateral and the high quality collateral. Just kind of reminding, it's like we're talking liquid investment grade bonds, but then you also have the operational efficiency, the automated settlement, access to the deep pockets of liquidity, and kind of like the deep variety of counterparts. For Eurex repo, we have 160 plus counterparts using our infrastructure, and they span from banks, pension funds, insurance companies, debt management organizations, central banks, and so on. You can see our participant list on our website. It's public knowledge. But I would say rather than repo becoming retail, what we see is repo becoming institutional infrastructure. It's kind of becoming part of the toolkit. But also similar to how clearing transformed derivatives, the end point will be that treasurers will start trading repo as a secured cash reinvestment tool. It will become normal. It's a robust tool, and it will be a very boring product, as it should be.
Yes. Boring is good for treasurers.
Absolutely.
It's not a very exciting statement. I see Sane laughing, but
no. But this is we do not want to be an exciting product. We want to be a boring product. We want to bring stability, return, and so on.
Yeah. No, makes sense. Glenn, so how can clients sign up really? Are there any special requirements? Is there any special KYC? Do they need to do a test? What is needed to be able to invest via OnePlus? You're on mute again, Glenn.
Apologies, I'm just going to keep the noise down. So certainly once you've signed up to TreasurySpring, you can access all the products on the portal. There's nothing specific that clients need to do for investing in OnePlus versus any of the other options on our e-portal. We've already taken care of the sort of due diligence component with Eurex. They've spent a lot of time, making sure that we're financially sound and a reliable participant. And we can be trusted to enter into the market, which is obviously that level of protection, that Eurex does is critical for the sort of holistic benefit of the product anyway. But from our own perspective, nothing special. However, the one thing, I do think that treasurers need to look at and, be aware of is that the protections of Eurex are mechanical. They are very, very good. The sort of like the banking regulators deem them to be about, the best that you can come by. However, it is slightly different. It's not like a look back over a historical debt performance or anything like that. The protection mechanisms are mechanical. So it is worth treasurers understanding what central clearing is, what even a QCCP is, because there is a higher delegation, which obviously Eurex is delegated, qualifying central counterparty, and just being fully aware and understanding of what those protections and that waterfall protection looks like, so that they're fully aware of the investment they're making.
Yeah, makes sense. So we're moving into the final 5 minutes of the webinar, just addressing the audience. If you have any more questions, and I see two, and we sort of already answered one of them, put them in the chat. This is your opportunity to poll this this panel right now. Jasper, wanna talk to you and go a bit more deep dive. We talked about repos, next day settlement, sounds all safe and sound. But how about the duration? How about cash, which I do not need for months? In a normal situation, the yield curve is positive. I also might want to do 3 months, 6 months investment. So how about the yield or duration versus yield question, especially from a treasury perspective?
Yeah. Yes. Well, that we do that too. Of course, we try to find some term premia and book longer dated repos up to a couple of months, maybe up to 6, 7, 8. There's liquidity out there. An advantage is if in the end you need the cash in between, you need it back more early than you anticipated in the beginning, then you can sell out the collateral, which we occasionally do. But of course you need a bid then. Eurex is not going to bid. You need a bank to bid on your overnight or Tomnext transaction to get the cash back. But that works. Also on year end and balance sheet dates. So that's good, and it allows you to actually take on the term trades and have some term premia. Of course, with current ECB pricing, it's somewhat tricky as it is being priced in or being priced out when Hormuz is being closed or opened. But yeah, it's a good proposition also for your longer term transactions.
Okay, makes sense. Sanay, your
just one question that I saw, and it's interesting as well. You know, people are asking about the technique to manage the liquidity, especially in the startup company. So, if we want to take a conclusion from the webinar of today, so you need the right tool that will allow you to see, you know, in a centralized position, your portfolio, your investment, so that what Glenn took us, you know, with all the TreasurySpring capabilities, etc. And then you diversify your portfolio because, as you mentioned, you have everything is urgent. You need access to your cash. You need very lower to insignificant risk, and that's what Katja was mentioning on all the Eurex investment and yield. So for me, it's a combination. You know, the right tool, the right products, and predictability. So this is an intern as well, intern to Treasury, how to maximize your forecast. How we say it. How you can really be sure about your forecast is to review it all the time and to have, you know, short, very periodical revision, you know, of your upcoming events.
I think you're probably talking cash forecasting. Laddering is pretty difficult to do. It does require some you know, technology probably to do it. You know,
of course, yes, of course, technology is.
That probably makes sort of terming out a little bit more difficult, because if you are slightly unsure of what your future cash needs are and you're, you know, what's coming up down the pipe, you know, that does probably sometimes push you into the shorter end. But you know, there certainly is some term premium out there. We have started to see shift in central bank policies just within the last few weeks. You know, it's definitely worth looking at. You know, we do have tools on our side that can help treasurers show that the benefits of either sort of investing short term versus long term, and they can run some simulations. But I think laddering and being sure of what your cash ladder forecast looks like is something that definitely treasurers need to probably get their heads around. And it is a slightly different area, but it is related. But it's definitely a bit of a technology uplift there.
Yeah, no, fully agree. And that, to be honest, Glenn, that could be a topic of a whole webinar to be cash buckets, investment buckets, cash flow forecasting, which is high on the agenda of every treasurer. To wrap up things, because we're at the end of the webinar, I think my main takeaway is make your treasury boring. That way you're making it safe. And a safe treasury, you don't have to talk to your CFO. You can tell your CFO everything is under control. My investments, my money is safe, and at the same time, I'm still earning a decent yield. I'm not getting emails. How secure is Bank X, Bank Y, Bank Z? I'm in repos. Even if they fail, I'm fully secured here. Hearing this, repos could be the future. Maybe it is, maybe it's not. Future will tell. It's definitely in the uplift. Thanks, panel. Thanks, audience, for being here, for asking the questions. Thanks, Katja. Thanks, René, Jasper, Glenn. Thanks for sharing your insights. I learned a few things today, which I didn't know yet. And thanks for sharing this with the world. And, with this, we end this webinar of today. Thanks for joining, and keep a look out for upcoming webinars via Treasury Masterminds. Thank you.
Thank you.
Thank you.
Yes.
Thank